The leaves are falling, and the question is, will the stock market do the same? Hi everyone, I'm David Scranton, and thanks for clicking on today's video. Fall can be a great time, right? But historically, it's often seen as a bad time for the financial markets. But will that perception prove true again this year in 2021? It is a question that many people are asking, and really it's based upon some recent developments. I'll be talking about those developments and what they can mean for the markets and your money on today's Market Update show. So we'll be covering what's caused the recent upsurge in market volatility, what issues might trigger even more volatility in the coming months, some historical perspective, and most importantly, what it all means for you. So let's take a step back. After hitting some new peaks in mid-August, Wall Street started to struggle. By late September, the S&P volatility, the vol, or really the fear index, jumped by 25%. On September 21st, all three major market indices saw their worst day in months. And that sell-off was blamed mainly on fears about Evergrande, China's largest property developer. Why? Because it reported that it was going to default on its debt. And the volatility, though, was also blamed on uncertainty over the Fed's September meeting. Now, that was confirmed when the markets rebounded partially after the meeting because the Fed signaled that it would start tapering its stimulus in the near future. But they didn't set a hard date, which the markets were actually happy about. And the same goes for raising short-term interest rates. The Fed said it's coming, but not before the end of the year. And the Fed's timing is going to be crucial to this whole thing. And you can expect to see, I believe, more volatility ahead of its November meeting. In the meantime, there are other concerns that we need to think about. One, of course, is the coronavirus. In some areas, hospitalization rates, infection numbers are now higher than they've been at virtually any other time during the pandemic. Another factor is the labor shortage, which is starting to impact companies' bottom lines. Inflation is one more issue, which until recently was the only issue that seemed capable of spooking Wall Street. In fact, according to the statistics from the Labor Department, the inflation rate hit a 30-year high in June. The inflation factor should continue, I think, to worry investors during the fall, based upon where we are, especially in this coronavirus recovery cycle. You see, phase one of the cycle is a recovery, or digging out of the hole. However, phase two is growth and expansion, and we're mid-cycle now. And being mid-cycle creates challenges for businesses that can impact earnings. Now, another closely related worry for the markets is the threat of rising long-term interest rates. Because rates spiked sharply earlier this year in the first quarter, but then leveled off and trended mostly downward since the end of March. That's also changed recently, with rates inching up amid all the stock market volatility. In fact, the yield on the 10-year government bond went from 1.25% in mid-September to over 1.5% before the end of September. And rising rates can create headwinds for income investors. Why? Because they push down the value of individual bonds. The good news is those headwinds can be minimized in an actively managed income portfolio. And most importantly, your income doesn't change. And perhaps the biggest market factor that virtually no one is talking about are the tax increases that will be necessary to fund the Biden administration's proposed spending. All totaled, the proposals call for $6.5 trillion in additional spending. And we still don't know how we're going to pay for the extra $3.5 trillion that we've already spent on coronavirus relief. And right now, investors, for some reason, don't believe all of that new spending will be approved, and hopefully they're right. Nonetheless, tax hikes are, of some extent, are probably inevitable. We saw the market jump by 20% with Trump's tax cuts. But the question is, will it fall by 20% with the Biden tax hikes? Or could other factors lead to even a bigger drop? As I mentioned, fall is historically seen as a tough month for the markets. And this is due in part to something called the October effect, which is the idea that financial markets decline and more market crashes occur in October than any other month. And strictly speaking, this isn't true, but the October effect is still a concern. Why? Because the markets are an emotional place. In other words, even just the fear of an impending market drop can actually be what causes the drop itself. So at the very least, that emotional element could add to the level of volatility that's being fueled by all the other factors that we've discussed. So let's summarize. The consensus among most analysts is that while 2022 looks good for the markets, the remainder of 2021 is likely to be volatile. Some forecasters say even a 20% drop is possible. But here's the good news. If you have the right asset allocation now, then it could be a good buying opportunity if and when the market drops. And what is the right asset allocation? Well, if you're retired or within 10 years of retirement, it's an allocation designed to help protect your assets and to potentially generate reliable income through interest and dividends, regardless of market conditions. So with that in mind, it's important to ask yourself some questions. Are you comfortable with your asset allocation? Has your risk tolerance changed? Are you sure that you've safeguarded and feel like you yourself are safeguarded from the impact of another major market downturn? Are you well positioned to take advantage of a lesser correction if it occurs? Those are questions you can answer with the help of the right advisor. One who specializes in asset preservation and retirement income. And now it's my favorite part of the show. It's time to bring in my good friend Jeff Small, president of Arbor Financial Services in Melbourne, Florida. Jeff, great to talk with you as usual.
Great to see you again, Dave.
And I know you are excited and fired up about our special guest today, and that is Steve Forbes, chairman, CEO, and editor-in-chief at Forbes Media. Steve, great to have you back. It's been 6 months. We shouldn't wait so long next time.
I agree. It's been quite a 6 months. Feels like sometimes 6 years or 6 centuries with all the stuff that's going on.
Yeah, no kidding.
Steve, Jeff Small here. Hey, listen, we're here to talk about the Biden tax proposal today and the budget proposal, and I really feel like the government is living in the land of fiction by taking a dollar from one person in the tax payroll and appropriating it to another one. Give us your take. Are they weaponizing the budget for politicization tactics at this stage of the game?
It's all a political thing more than an economic thing. They want more control over people. They want the middle class and upper middle class to be dependent on government. That's why they have all these new entitlements. And the whole tax program is designed to make people feel they won't pay taxes. But as you know, with the corporate tax, who ends up paying it? It's middle income people. And there's a lot of research to back that up. So it's a sham. It's all political, and it's going to do immense harm to the economy.
Yeah, this is craziness what's happening here. And it's just one of those things where we have to sign it before we read it. Who is masterminding these budgets? Is it really Bernie Sanders that masterminded this budget?
Bernie Sanders is the virtual president these days. The far left of the Democrat Party, with AOC in Congress and others, they're the ones calling the shots. And so-called moderate Democrats, even though they make noises from time to time, are fearful of primary challenges from the far left. So you have this determined minority of political activists of swaying the whole Democrat Party and also trying to fundamentally change the country without a mandate, without real debate about what they're doing.
So Steve, let's break it down then. You mentioned the corporate taxes. Where do you think it's going to get negotiated? Where do you think we're going to end up? We're 21% right now, 25, 28. If you had a place to bet, where would that be?
Oh, they'll probably do 25, 26, which sounds small compared to what they're talking about before, but is still immensely harmful. And if they do the 26.5 that the House Tax Writing Committee was talking about, that would, combined with state taxes, make the U.S. the most onerous corporate tax country in the world. We'd be higher than China, higher than Russia, higher than the rest of the developed world. Really destructive and harmful.
Yeah, none of that sounds good at all. In our next segment, I want to ask you about how you think that might affect the markets, because I know that's what our show's about today. And I know we had the Trump bump because the markets went up on anticipation of a drop in corporate rates, and it did. Will that reverse itself? But before we get there, how about the other thing, capital gains rates? I mean, if they have their way, they'd like to basically merge capital gains rates and ordinary income together. Your thoughts on where that might come out?
Well, again, they've proposed something that would be horrible, raising the capital gains tax to almost 44%. So when they quote compromise, 25%, then you add on the 4% from the Obamacare tax, that's still 29. That's one of the highest it's ever been. And again, when you combine with states, it makes it catastrophic. And what they refuse to tell you is that every time they raise the capital gains tax, government revenues go down, not up, because people refuse to recognize gains if they're going to give most up to the government. That's why the Democrats are mooting about. We'll have to see if they slip it in, where some people, even if you have an unrealized gain, you're going to have to pay a tax on it. So your stock goes up from, say, 20 to 30, you're going to have to pay a tax on that gain of 10, even though you didn't sell the thing, which is going to have forced sales, which will depress the stock market. Bad stuff again all around.
So really quick, obviously, I want to know what you think is the worst part of this whole thing. I mean, tax brackets are going up for the higher income earners in terms of ordinary income. Capital gains rates are looking to go up, corporate taxes. What is the single worst for a country?
Well, you'd have to have a real fight between the corporate tax and the capital gains tax. And the corporate one would be the most immediate. You'd have money flowing out of the country instead of into the country. You would have less investment, which means less pay, which means less dividends, which means fewer jobs. Again, the economy is going to take a hit, but the Democrats don't care on the far left because they just want control, period.
Right.
Steve, to springboard on our prior conversation on taxes, stocks don't climb the wall of worry. And I don't think the market has factored in the jeopardy or the tax peril that's built into this new Biden budget. So tell us what you think is going to happen when this budget is finally passed into law in the last hour. Usually these things are passed to avoid a government stalemate.
Well, if they do end up getting this, some of this through the House and through the Senate, it is going to affect the economy, which ultimately affects stocks. The market has been assuming that these bad things are going to get sidetracked or substantially watered down. Now the moment of truth is coming. But the key thing is not to focus just on how much money they say they're going to spend, $3 trillion, $5 trillion, pick a number. The key thing is what they're going to be putting into these bills, what they sneak in. If they put in these new entitlements, they always start off small. They have 4 big ones they're sneaking in. They start off with a small amount of money, then they mushroom in the years ahead. And entitlements are very difficult to scale back, not to mention even trying to get rid of them. So this is going to bust budgets in the future, which is going to hurt the economy and also hurt our national security, which means less money for defense. Well, we need a real buildup given what's happening with China and to a lesser extent with Russia and Iran.
Steve, these are really scary times to be seeing all these things happening because the market is trading at 22 times its forward earnings, and it hasn't been this high in valuation since 2001. And we know what happened back then, but with all these different headwinds, when will the market, do you think, finally when will they price in the wall of worry here? When do you think the market will actually physically react with the Fed taper, with accelerating inflation, et cetera, et cetera?
I think the first market reaction will be if Congress actually passes these new taxes in some form and these new entitlements, which will hurt the future. That'll be the first big hit. Then the next one will come with the Federal Reserve. The Federal Reserve has been trying to tamp down money creation by the device called reverse repurchase agreements, which means they borrow money short-term overnight. That number is now $1.2 trillion. They remove an overnight money from the banking system. They won't be able to continue that much longer, that gimmick, if you have Congress passing these big spending bills. So that means, as we know, when you print money 6 to 12 months down the road, you're going to get inflation. So short term, the market's going to take a hit with these taxes, and the longer term with Federal Reserve monetary inflation, the likes of which we haven't seen since the 1970s or the early 2000s. We know what happened in both of those cases. Not good for stocks.
Steve, what's amazing me about this, though, is that it's not happening on anticipation of this, right? When Trump was elected, his tax cuts had not been enacted yet, but the markets went up just on anticipation of it because markets are forward looking. And I don't think any market participant today thinks that, any investor thinks that capital gains rates aren't going to go up at all or corporate taxes aren't going to go up at all. So why do you think that is? Why do you think the market seems to be shrugging it off if markets are forward looking? I mean, this is imminent, isn't it?
It is. And in the case of Donald Trump, when he got elected in 2016, you had Republican control of both houses with decent margins. The Democrats have razor-thin majority today in the House, a tie in the Senate, which puts it on the vice president. And so I think the markets are just looking all the cash out there. Corporations are loaded with cash. Consumer balance sheets overall are in good shape. And they're figuring, this means better earnings ahead. But I think the markets, I'm surprised, really, they haven't woken up to the fact that maybe those bad things won't happen, but there's a chance they will happen. So you should factor that into prices today and not get smacked if something bad does happen.
So Steve, really quick, I know you're not a financial advisor per se, and I know your answer might be, I'm going to leave that to you, Jeff and Dave, right? But if you were someone who's retired or within 10 years of retirement, who's in the stock market, would your tendency be maybe to take a little bit of your gains off the table right now in light of what's happening as a very general comment?
Yes. If you're about to go into retirement, if you're younger, I just ride the storm through with your retirement accounts. You'll always come out ahead in America, despite how bad things may look at a particular moment. But in terms of your own retirement, you should always have a cash reserve. You never know what's going to hit you. Mm-hmm. And in terms of another thing you ought to look at, and I know this is a dangerous thing to say, but you also should look at owning some gold, preferably in coins or bars, as an insurance policy, not an investment, but as an insurance policy of crazy things that our central bankers and politicians may do. Not a lot, but a little. You'll sleep better, a little better.
Yeah, insurance policy these days actually feels like the right thing to a certain degree. So Steve Forbes, Jeff Small, it's been my pleasure. Thank you.
Thank you.
Thank you, Dave.
Thank you for watching today's video featuring my fall market update. If you enjoyed this video, please click the thumbs up button to give us a like and make sure that you subscribe to our YouTube channel for new content each and every week.